Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
Welcome to the U.S. Markets Update. I'm Dan Koh. Now, some positive sentiment is building up for this week with the S&P 500 closing higher on Monday. And that comes as Wall Street regained some of its footing after a week in which the artificial intelligence trade have lost quite a bit of steam. Now, the broad market index climbed about 0.3% higher overnight to finish off the session at 6,661 points. Nasdaq Composite advanced 0.5%. to close off at 22,591 points. Now, the Dow Jones Industrial Average settled up about 0.2% at 46,316 points. And that comes after skepticism around the AI trade, which put pressure on the broader stock market last week, have seen the return of some bullish movement after a couple of AI stocks from the likes of Nvidia, AMD, and Micron Technology all rose higher overnight. And meanwhile, prediction markets are pricing in at about 70% chance that the federal government will likely shut down on Wednesday. That's reflecting some growing skepticism that lawmakers will strike a last-minute deal to keep agencies funded. So what could this mean for the broader economy? Well, let's find out with Sonu Varghese, the Vice President and Global Macro Strategist at Carson Group. Good morning, Sonu. How are you doing today?
I'm well, Dan. Thank you for having me. Nice to talk to you.
It's a pleasure to have you on with us today, Sonu. Now, let's first look at the U.S. stock market, where we are seeing investors regrouping after a losing week that saw cracks emerge in AI-focused stock trading, as well as surprise tariff announcements on movies and furniture from President Donald Trump for tomorrow. And despite that, stocks are still on pace to finish September and the third quarter with gains. So, we're seeing how, as October is typically volatile for stocks, how significant is that movement going into the fourth quarter? And do you think the seasonal pattern for the fourth quarter will play out this year?
I think so. In one word, momentum, right? Markets like to be, investors like uptrends, and momentum begets momentum, as I like to say. And look, Dan, we just had 5 straight months where the S&P 500 is finished positive. And historically, when that's happened, over the next 3 months, you have, you tend to have a positive return on the S&P 500. Plus, October tends to be a little volatile, but, once you get past that, overall Q4, the fourth quarter return, October through December, especially when you've got double-digit gains through the first 9 months of the year, the median return over the fourth quarter tends to be about 5%, at least looking back, all the way back to 1950 through last year. So, the market, I think we have a strongly uptrending market and momentum works.
Wonderful. That's something to look forward to, at least moving into the month of October. Now let's turn over to the U.S. government shutdown, where investors are currently eyeing this latest event that risks delaying the release of the all-important monthly jobs report later in the week. Now, a looming federal government shutdown appeared more likely after top Democrats and Republicans met with President Donald Trump at the White House on Monday. And for all the political firestorms that they generate, we've often seen how government shutdowns have historically been non-events for both markets and the economy. But some analysts are saying that this time it might be different. So how much of an impact do you think it could realistically have on the economy or markets this time?
Right now, it looks like the different parties involved on both sides of the aisle, there's a lot of posturing. And it's hard to say whether they'll come to a deal or not. I think I would just go with market odds of, maybe 70%. Maybe slightly higher, 70 to 80% chance of the government shutting down in a couple of days. But usually with these things, the government doesn't stay shut for a very long time. The last time we had a lengthy shutdown was at the end of 2018 into the first part of 2019, so 34 days then. And guess what the S&P 500 did during that time? It rose 10%. But now that was not because the shutdown was good for the economy or anything like that. It was because the Federal Reserve signaled that they were going to cut rates after being in a hiking cycle. So I think other things that are happening that impact the economy and the markets tend to be more important. And in fact, right now we're probably in the middle of another cutting cycle and the Federal Reserve pivoting from a pause to rate cuts. And that, I think, is an added tailwind for markets, in addition to the momentum.
That's a good point that you raised there. Thanks for that, Sonu. Now let's turn over to the US GDP numbers, where we're seeing the output of the US economy bounce back more than previously thought in the second quarter, powered by an increase in consumer spending. I mean, based on data, we're seeing the second quarter GDP revised higher to 3.8% on the back of stronger consumption. So how sustainable do you think this would be in the strength of the consumer spending? And as we're seeing, July and August also enjoying the same amount of optimism and as well as the robust consumption, do you expect this momentum to carry into the final quarter?
Based on the evidence we've seen so far, it looks like it is continuing, because we did run into a bit of a shock with the tariff chaos in April and May. And guess what? As you just mentioned, the second quarter's GDP, real economic growth, after adjusting for inflation, was actually better than initially thought. And that was because consumption, 70% of the U.S. economy's consumption and spending, that was better than expected. So what we would be looking for is, does that continue? Normally, you think if the labor market is really weak, ergo, consumption should slow, spending should slow. That would kind of make sense. But then we're kind of seeing the opposite. In July and August, spending has risen at an annualized pace of about 4.5%. That is incredible. And that's after adjusting for inflation. So part of me thinks maybe the labor market is not as weak as we think it is, because when you take the totality of data, things don't look too bad.
That's an interesting point that you raised. And sticking to GDP, we've also seen how, spending on AI is making an outsized contribution to GDP growth. In fact, a report had just recently unveiled that the impact of software and technology investments on real GDP growth has surpassed 1 percentage point for the inaugural time in history. So how much of a driver do you think this is likely to continue to be for the U.S. economy? And is there a risk of markets becoming too reliant on a narrow set of stocks and themes?
I will take your last point first. I think it is a risk when the economy is reliant on a narrow sector that basically makes up about 5-6% of the economy. I mean, if you take AI-related investments, and this is both hardware and software, to your point about, that contributing, making an outsized contribution to GDP growth, especially over the first half, it contributed an average of close to 1.1 percentage points. That's as much as consumption. And as I said, consumption makes up 70% of the economy. So about half of GDP growth came from this really small area of the market. And for now, I think that continues, because we are probably, to use a soccer analogy, maybe in the first half of AI-related investment. You see your Oracles and NVIDIAs and OpenAIs of the world just announcing day after day, week after week, saying we're going to build more data centers, we're going to invest more in chips to train our models and all of that. So I think we're still in the early innings part of it. But circling back to the top, yes, if the economy is starting to be reliant on a particular small sector, you have to ask the question, what happens when that ends? But that's a question, I think, for a later date. For now, I think it continues, Dan.
It's great to hear that at least optimism still returns to the market, and at least for now we're seeing that staying as robust as possible. So let's now turn our attention over to inflation, where it's still stuck above the level that most Federal Reserve policymakers consider healthy. Well, the Personal Consumption Expenditures Index, that's the Fed's preferred measure of inflation, that climbed at an annual rate of 2.7% in August. That's a slight increase from the previous month, and in normal circumstances, that increase might, preclude policymakers from lowering short-term borrowing rates and risk stoking inflation. But that's a bit different this time. What can you tell us about inflation and interest rates today?
I think inflation is elevated, and it seems to be going in the wrong direction as far as the Fed's concerned. The Federal Reserve's target is 2% right now. Core inflation, using the metric they like to look at, the core personal consumption expenditures index, that's running about 2.9%. So we're going further away from their target. And it's for two reasons. One is because of tariffs. Tariffs are having an impact on durable goods. Durable goods inflation is running about 1.2% over the past year. And if not for tariffs, prices would probably be going down. it would be exerting a disinflationary force on inflation. But if that was the only problem, I think we could say, you know what, tariffs are only going to be a one-time thing, and the impact on durable goods inflation should pass. It is, quote-unquote, transitory. The problem is we're seeing some heat in services inflation as well. Like now, services inflation is running about 3.6% year over year, whereas the historical average, if you go back 1996 to 2020, it was about 2.5%. So we are well above that. So I think the Fed has a problem. But this in and of itself tells you why markets like the tailwind of, the Fed cutting rates in the middle of elevated inflation.
Yeah.
So I think that's positive for the market.
Yeah, it certainly is a hard it's a hard beam to balance when it comes to inflation, especially on the back of a weakening jobs market as well. So we'll wait and see how this plays out for the rest of this year. But meanwhile, thank you so much for joining us today, Sonu.
Thank you, Dan. Thank you for having me. It was nice chatting with you.
It's a pleasure. Thank you so much. We've been speaking to Sonu Varghese, the Vice President and Global Macro Strategist at Carson Group. Stay here with us on Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.